All right, today we're going to tackle a really fundamental concept in Canadian tax law, how we figure out where a trust is actually resident for tax purposes. You know, this might sound simple, but it's an absolutely critical question, and it has some pretty significant financial consequences. So, let's dive right in.
And before we get started, I just want to note that the material for this explainer was prepared by Samir El-Rashani with AI support.
So here's our game plan. First, we'll start with an introduction to trust residency itself. Then we're going to look at a huge landmark court decision from 2012. After that, we'll break down the legal test that came out of it. We'll explore some tricky scenarios. Who really has control? And finally, we'll wrap it all up with the key principles and takeaways you need to know.
Okay, so let's start by laying the proper foundation. What exactly are we talking about when we say residency of a trust?
For trusts here in Canada, everything, and I mean everything, hinges on this one concept, factual residency. This is the main event. It's not about where the paperwork was signed or where the bank accounts are. It's all about where the trust is truly managed and controlled. It's about the reality on the ground, not just what's written on paper.
Now, this is where things get really interesting, especially when you compare trusts to corporations. You see, for corporations, the rules are way more complex. You've got factual residency, sure, but you also have deemed residency rules, you've got all these different tax treaty rules, and it all leads to situations where a corporation can be a resident of two places at once. With trusts, it's so much simpler. We focus almost entirely on that factual residency piece, which means dual residency is pretty rare. This makes our job easier in one sense, but it also puts a ton of pressure on getting that one determination, factual residency, exactly right.
But this sharp focus on factual residency wasn't always so clear-cut. So for our next section, let's look at how one huge court case back in 2012 basically changed everything and brought a lot of clarity to this part of tax law.
If you rewind the clock to before 2012, the whole area was, well, it was a mess. There was a ton of uncertainty. Tax professionals, the Canada Revenue Agency, nobody had a really clear authoritative test for figuring out a trust's residency. And that, of course, led to all sorts of inconsistencies and legal fights.
This timeline here really paints the picture perfectly. You have the messy, confusing pre-2012 era, then bam! In 2012, the Supreme Court of Canada steps in with its decision in the Fundy settlement case. And from that point on, we had a clear, binding standard that applies to all trusts. And what was that standard? Well, this quote right here is the absolute heart of the ruling. The court didn't invent some brand new test just for trusts. Instead, they said, that test we've been using for corporations for years, the central management and control test, yeah, we're going to use that for trusts too. And that right there was the game changer. So that brings us to our third section. Let's break down exactly what this central management and control test, or CMC test, is all about. A good way to think about it is that we're trying to find the brain of the trust, its real nerve center. At its core, the CMC test really just asks two main questions. First, who has the real ultimate power to make decisions for the trust? And second, this is the crucial part, where is that person or group of people when they're exercising that power? The answer to that second question, the where, is what determines the trust's tax residency.
Now, the starting point, the general rule of thumb, is that the central management and control rests with the trustee. The law just assumes that the person or company that's legally appointed to run the trust is the one who's actually, running the trust.
So we can really boil this down to a simple three-step process. Step 1, figure out who the real decision maker is. Step 2, pinpoint the geographic location where they're making those important decisions. And step 3, that location becomes the trust's residency. It sounds pretty straightforward, right? But as we're about to see, the real world is often a lot messier.
And that brings us right into our fourth section, where we get to explore those messy, complex situations. What happens when it's not so obvious who's in charge?
So here's a question I get all the time. What if you have more than one trustee, and they're all in different places? Say you've got one in Toronto, one in New York, and maybe another one in London. How on earth do you figure out the residency then?
Well, the answer comes down to this really important idea called the substantial control principle. The law doesn't just do a head count. So just because 2 out of 3 trustees are in Canada, that doesn't automatically make the trust Canadian. Instead, we have to ask, where is the more substantial, the more meaningful, the most critical part of the management and control actually happening?
This leads us to an even more interesting question.
Is it possible for someone who isn't even an official trustee to be the one who determines the trust residency? You know, someone like the settlor, the person who created the trust, or a main beneficiary.
And the answer to that is a huge, unequivocal yes. This is where that classic legal doctrine of substance over form comes into play. If all the evidence shows that, say, a settlor is the one really pulling all the strings, and the trustee is basically just a puppet acting on instructions, well, then the CRA and the courts are going to look right past the trustee and focus on where that influential person is located.
This table makes the point perfectly. Let's look. In scenario A, everything's simple. The trustee is in Toronto, and they make all the real decisions in Toronto. No-brainer, the residency is in Canada. But now look at scenario B. The trustee is still in Toronto on paper, but they're just taking orders. The settlor, who lives in Miami, is the one making all the key decisions. What to invest in, when to pay out money. In that case, the substance of the control is in Miami, and therefore the trust's factual residency is in the USA, not Canada. This is such a critical distinction to understand.
Okay, let's move into our final section and really cement these ideas into the key principles that every student and professional needs to have in their back pocket. So, let's bring it all home. 4 key principles. 1. For trusts, it's all about factual residency. That is the main event. 2. The tool we use to find it is the Central Management and Control, or CMC test. 3. And this is so important, residency is about where the power is actually used, not just the address of the trustee. And finally, number 4, never ever forget that people who aren't even trustees can be the ones who determine residency, if they're the ones with the real power.
So at the end of the day, why does any of this matter? Because getting the residency wrong can have massive tax consequences. We're talking unexpected tax bills, penalties, and long, drawn-out fights with the tax authorities. So for anyone who works in tax planning, compliance, or advises clients on trusts, getting a handle on these rules isn't just a good idea, it's absolutely essential to your job. Now, if you want to go even deeper into the details, and I encourage you to do so, the best official resource from the Canada Revenue Agency is their Income Tax Folio S6 F1 C1. It's called Residence of a Trust or Estate, and it's the definitive guide on this topic. And I'll leave you with one final thought to chew on. We live in a world of remote work and global mobility, right? A world where a trustee could be in one country, a beneficiary in another, and they make all the key decisions on a Zoom call that spans 3 different continents. So the question is, how will their old principle of where power is exercised have to adapt and evolve for this new reality? It's a fascinating question, and one that tax authorities and courts are definitely going to be wrestling with for years to come.